Welcome back everyone to the Moneycontrol live stream. You're watching markets with Santo and CJ. Well, it seemed like, it was a very difficult setup in the morning, but we have defied the odds and bulls have taken charge of the setting on the Lal Street at this point of time.
That's made CJ a very happy man.
Absolutely. I mean, yesterday the bulls gave up the fight, towards the end, but it seems like today probably we are going to hold steady and close the day on a higher note. If you look at the Nifty and Sensex, they're all set to end the day on a higher note, probably close to 1% gains on both the benchmark indices. Look at the sectors that are driving. Clearly, the beneficiaries from lower commodity prices, auto, FMCG, even banks have joined the party. So a lot of broad-based gains, Santo, in the mid and small cap space as well. And importantly, from a future near-term perspective also, you look at the India VIX, which is the fear gauge, that also is now threatening to go below the 20 level, which will be a positive signs for the bulls out there.
Well, my only worry in this whole thing, CJ, is that you're seeing trading volumes, come off slowly and steadily. Okay, this indicates that there is less participation, and when participation is less, the market becomes very vulnerable to a sharp move on either side. And at this point, I would say that the risks are more on the downside, given that your fears of recession, disappointing first quarter earnings, or at least lackluster first quarter earnings. Oil prices are coming off, but they are coming off because of fears of a deep slowdown globally. So not a very pretty picture at this point in time. I think market is moving up on, as I've been maintaining the stance, it's moving up mainly because of lack of selling pressure. Even FIs seem to be realizing that they can't sell anymore in this market without breaking the price. The market probably has absorbed as much as it could. Even the domestic institutions are now showing signs of fatigue. So this is a very treacherous market, as I would like to put it. Of course, it's managed to hold above key levels, but well, CJ, let's see.
Well, Santo, I think 16,000 is the level that we hit today. It will be important to see whether we'll sustain above that or not on a closing basis. Well, that could be a different sort of a story then for the bulls. But I think my only observation here would be that yes, volumes are falling, but volumes have fallen along with a decline in price, Santo. And I think that probably goes to show that the selling pressure in the market has clearly abating at this point of time. Maybe there is exhaustion from the seller side. Now, there can be two situations here. Either you could consolidate for a very, very long time, or bulls could take the cue and maybe you could start, a recovery in the market probably towards important levels as we move forward. So I think it will be very interesting to see how this all, plays out along with the Q1 earnings. So we'll keep an eye on that. But individual stocks, well, a lot of action on a lot of many counters out there today. I mean, the mid cap, small cap space had a lot of stocks buzzing. We'll start it off with Santo.
Macrotech developers. Now, the first quarter update was pretty strong, CJ, and so it might sound a little counterintuitive that I'm still cautious on the stock.
I'm very surprised, yeah.
Despite strong Q1 numbers, the highlights mainly were the sharp reduction in debt. That has come off. The company had guided for aggressive reduction in debt, and it's been maintaining that. The even bigger surprise probably was that the pre-sales guidance, for the year as a whole, they had guided for about 2,500 crores, of which they have already done 75% in the first quarter itself. Now here is the catch, CJ. After all this, the stock, has not been going anywhere for a while now. It peaked out sometime in December. Since then, it's been coming off, even though the sentiment for real estate has been pretty positive. This has been seen even in the case of...
Has it though? I mean, with interest rates rising, everybody got into that narrative, that, oh, the rally in real estate.
But look at the numbers, right? If it's done pre-sales in the first quarter itself, and yet that's my only surprise, that prices aren't reacting at all. So probably this could indicate that, the best is behind. Market has factored in most of the positive, or everything is adequately priced in at these levels. So that makes me a little cautious.
I think on the contrary, Santo, the best is yet to come for Macrotech. If you look at, I mean, I'll say that solely on the basis of the fundamental performance and the stock performance. The stock is down anywhere between 30 to 35% from its record highs, right? That also, of course, came on the back of that emergency rate hike, and then the entire narrative around real estate sector changed. Now the company come out and said, oh, look at this, look at the number, the amount of sales that we are doing, look at the sort of debt reduction that we are doing. There is no way that our stock deserves to be 30% lower from record highs.
That is the reality.
Yeah, and I think that is why you've seen the upturn, upswing in the stock today. I mean, the stock was higher by almost 5% at the last I checked. So clearly, for me, the fundamental side of the business remains quite strong. Residential demand, property demand is very strong at this point of time. And the general perception in the banking space is that, banks probably or borrowers generally or home loan borrowers generally will be able to absorb 100 to 150 basis points rate hike. We are still about 60 basis points away from that. So clearly there is some room to, for demand to grow. And lastly, I think you look at the recent news flow that came around Macrotech, the fact that they are now expanding to the Bangalore, space, which is also, of course, a very highly competitive, market. But the fact that they are expanding there, plus Pune is already there, and they are already a very well-established player in Bombay. Clearly, I think they are now, dragging the levers to achieve that sales target of about 20% on an annualized basis for the next 4 to 5 years. So I think overall fundamentals should really make investors very happy, even if the stock performance is not reflecting it at this point of time. Another stock, Santo, I talked about Nykaa in the morning. I told you that with expectations probably building up of a rate cuts happening in the US next year on recession fears, you will see technology stocks come into action, and that is clearly what has happened today. The stock surged in line with a lot of its global peers overnight in the Nasdaq in US. Generally, I mean, see, the main reason here is it's a very tactical sort of a thing. If interest rates go down, then it becomes much more palatable for investors to buy, highly rated or highly valued stock which are loss making, because then they can discount profits much farther in the in the future at a very attractive pricing in the present value terms. Going ahead, at this point of time, there are already murmurs that rate cuts could start happening in the US in the second half of 2023 if the ongoing energy crisis and the global slowdown continues. Lastly, the stock has fallen 70% from its IPO price, right? So clearly, the downside is going to be very limited, and any upside could be meaningful from here. So the risk reward also becomes quite attractive for investors.
Well, CJ, now let me understand it right. You're saying that when interest rates are low, anyway, it makes sense to buy tech stocks, right? Money is cheap and you discount them and say that, okay, they'll make profits some 20, 30 years.
Not 20, 30 in
right? Okay. And now we've seen rates rising, but even before they have peaked, you're already building in saying that now the rates are going to ease, and that's why again you should get back into tech. Now, my argument against this whole theory here, CJ, is that this is a market where again investors are becoming very, very finicky about Paytm.
I think they already are very finicky.
They are finicky. Now look at it, there's been a flood of buy reports on Paytm over the last couple of months, right, saying that it's deep value and all that. Yet the stock has been struggling to stay above 700. It's just been in a narrow range for almost 4 months now, 4 months, okay. I think it is very evident that in this market, when there are, people are taking a safety first approach, they might want at least another couple of quarters of performance to see that Paytm is on track to deliver on what it has guided. Sometime in 2023 is what it said. So maybe market is saying, look, there are plenty of other names which are, good dividend yield, reasonable profits, visibility, everything, in an uncertain market, let's go for that. So that being the case, I think Paytm at this point is more a victim of the overall market conditions more than anything else.
Well, Santo, I think the play here is simple. Either you play the present of the market or you play in the future. Generally, investors will want to get in early. You early bird gets the worm, right? And I think that is the play that I'm trying to make. Of course, if you look at it from current scenario, it does not make sense, right? Right now, you want to go with safety, you want to go with dividend yield stocks and whatnot. But if you look at 6 to 12 months ahead, I think if you get in early in these sort of, not of course whole hog, not take your entire savings and put it into the stock, but clearly staggered investments could work out in your favor going ahead in next 6 to 12 months.
The man who saw the future. Well, AIA Engineering is the third stock on a watch list. Now, CJ, there's been a surprise performer. This despite the fact that a big chunk of its revenues are closely linked to the mining sector, on the outlook on which is pretty grim at the moment. Now, fourth quarter numbers were pretty good, and since then the stock has been a steady performer despite many analysts flagging the fact that a weak outlook for the mining sector could actually dampen sentiment for the stock. Now, AIA Engineering is into the business of manufacturing metal castings, and the main industries it caters to are cement and mining. Now, mining, there's a bit of the outlook is slightly cautious, but the company has got two projects, which are about to go on stream. One is its greenfield project relating to the milling liner project, and the second one is the brownfield project, in Kerala for the grinding media. Now the management is pretty hopeful that these two will boost volumes, and also lastly the company's valuations at this point, it's been able to pass on most of the higher freight costs and input costs on to its customers, which is also being seen as a big positive. That's not something that most companies have been able to do in this kind of an environment. Besides, the company is also trying hard to increase penetration in the replacement market, where it feels that it should be able to do well.
Well, Santo, I have no complaints for a stock like this. I mean, of course, it's been one of those value picks from the manufacturing space that a lot of investors have been talking about. The March quarter earnings clearly were a testament to the turnaround that the management is trying to get into the company going ahead. Of course, the mining side of the business will remain a drag. That is something that I feel that probably could limit the upside going ahead on the counter, given that we have already seen almost 20 to 25% year-to-date gains on the stock. But overall, I also don't see much potential for downside going ahead if they can sustain the sort of momentum that they showed in the March quarter. Moving on, one stock that came into the limelight or investors today, thanks to Goldman Sachs, of course, is Kotak Mahindra Bank. Now, well, Kotak Bank has been a rank underperformer in the banking space for the past 1.5 to 2 years. A lot of it has to do with the conservatism that the bank had expressed during the pandemic period, because it did not want to be caught out in another bad loan crisis like many of its peers have in the past, trying to go aggressive when the lending cycle has just turned positive. Now, Goldman Sachs is of the view that the excess capital that Kotak Bank has, and the fact that it has not been able to utilize it too much in terms of lending, lending it to borrowers out there, that could change in this new lending cycle. They believe that the bank is well capitalized to take advantage of the the opportunity or the upturn in credit offtake in the economy, and they're expecting the market cap of the stock to touch $100 billion in the next 3 to 4 years, from about $42 billion at this point of time. So clearly, Goldman is very, very optimistic. On the back of that optimism, they've upgraded the stock to buy rating, as well as expecting a 28% upside over the next 12 months. Of course, the bull case is much higher than what they're what they're expecting for the 12 months, but clearly a stock that they are really looking out for in the BFSI space. And overall, Kotak is one lender that has also suffered because of the premium valuation that it commands. Much like HDFC Bank, of course, these two lenders have been the underperformers within the banking space, but maybe slowly and steadily investors will start turning their attention towards these stocks where there has been a lot of underperformance.
Well, I agree with you on most points, CJ. In absolute terms, I think after 2 years of underperformance, almost 1.5 to 2 years of underperformance, Kotak is now beginning to look attractive in the overall private sector banking space. Although my only contention would be that at this point, were I to just pick 1 or 2 stocks, then probably I would still perhaps want to go with ICICI Bank and HDFC Bank, which seem to offer better potential from these
Going
levels.
with the recent track record, are we, Santo? Nice.
Well, United Breweries is the last stock on our watch list. Now, again, lot of concerns flagged after the fourth quarter numbers, and yet the stock has managed to defy it all, and it's now topped 1600.
I will not get that at all. Yeah? I don't know how it has done that, but somehow it has
managed to do that. The same way PAVR is also rising, even I don't get that. But in this case, it's pretty much straightforward, CJ. It's not a very complicated story here. It's got a good balance sheet. Also, beer demand has been steadily on the rise, and given the demographic make of the society at this point in time, beer does seem to have a good future. But most of it, I think, right now is the near-term play. I think a lot of traders would have got into the stock because Q1 typically is a good season, is a strong season for beer. Beer consumption does go up in summers, so probably there's a short-term play which traders seem to be making at this point. All these factors put together is what is driving the current uptrend. Now, I'm not sure if this uptrend can sustain, but definitely the downside from these levels also looks limited to me.
Well, Santo, I think I am only concerned about the upside, and I really don't feel that the upside is going to be quite great out there. I think probably United Breweries is one of those stocks because because of its strength in the balance sheet, because of the largely stable earnings environment that it operates in. Investors will probably flock to these sort of stocks throughout this year, given the volatility. But the moment the market turns bullish, right, the moment the risk appetite comes back, you will see stocks like United Breweries being left behind. And I think that is my bigger concern with this stock. Apart from, I mean, of course, on the fundamental side, there are concerns around inflation. With rising inflation, we've already seen that consumer sentiment is taking a hit, consumer demand is taking a hit. You look at the employment statistics that have recently been put out by CMIE, they are suggesting there has been a slowdown in rural employment as well as overall employment scenario in the country. So clearly that is not something that is very, a good sign for a discretionary consumption item like alcohol beverages. Apart from that, the big, of course, elephant in the room for a company like United Breweries will always be the overhang of tax increases on, sales, because governments, you have seen that they have reduced ad valorem taxes on fuel in order to provide some comfort to consumers, but they also at the end of the day have to balance their books, and generally alcohol tends to be that that duck in the water that usually gets shot in these sort of scenarios. And clearly I think probably going ahead this will be one risk that will weigh on the stock. We have seen this play out with ONGC. The market was not believing in the rally. The market was like, wait it out, anything could happen, and it ended up happening. I think similar fears exist for United Breweries as well, and I think that is one of the reasons why I would probably not touch this counter at this point of time.
Well, with that, we come to a last segment. What do we have on the horizon, CJ?
Well, Santo, it's the FOMC minutes, the recent Fed meet where we had the 75 basis point rate hike that happened, which of course a lot of people were not expecting earlier, but of course because of certain quote-unquote leaks in the WSJ, ultimately the market was able to digest it. But we will now be able to understand the thought process behind that decision when the minutes come out, and there are already reports that the minutes could hint at another 75 basis point rate hike going ahead. So clearly at this point of time, the markets, momentum going ahead, whether this sort of a pullback that we have seen in the market today, whether that will sustain will depend on what the FOMC minutes have to say later in the evening.
Just wait a minute, CJ. Now, you're saying bond yields are cooling because they see lower interest rates coming off quickly, and now the minutes, the expectations are that 75 basis points.
No. So this is of course from the central banking side, right? Market is already jumping ahead of the central bank. That is why I feel that the next FOMC meeting, when it happens in July, would be very critical to watch, because the market is already telling Paul that, bro, you are behind the curve. You are behind the curve like anything in this world, and we are already expecting you to cut rates. You are hiking rates right now. Well, I think you would want to reconsider that, because we are already expecting you to cut rates in another 12 months.
When the recession sets in, that
exactly. So that is why I think this is going to be a very big fight between what the market is hinting to the central bankers and what the central bankers are worried about at this point of time, because they have, anyway, everybody knows it's not, it's the worst kept secret. The central bankers have wasted a lot of time in their fight with inflation. Now let's see how that progress is going ahead.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching, and do let us know what you thought about the show in the comment section below.
And as usual, guys, follow us on the social media links at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live 9 a.m. sharp tomorrow morning.